Did you know having a bad credit score can hurt your chances of getting a mortgage? And if you manage to acquire a mortgage, it could cost you more in mortgage payments? Today we're here with John Sinnott, mortgage broker from Dominion Lending Centres. John is going to share with us why it's important to have a good credit score. Over to you, John.
Hi, Maureen. Good morning, and thank you for having me on your channel today. I'm happy to come here and talk to you just about credit reports and credit scores, give you a better understanding of how it works. A credit report is a report that a bank or a lender will check and pull in order to determine someone's credit worthiness. So credit reports are generally handled by two different companies. One is called Equifax, the other is TransUnion. And depending on the lender or the bank, they'll use one or the other. Sometimes a lender will actually use both. And they should be fairly the same, but they may in fact have different things reporting to them.
So that's why you would go to one versus the other?
Yeah, that's why some lenders will generally pull both. But for the most part, they should be fairly similar. So just depending on what lender has an agreement with that credit agency. So for example, I believe RBC, that bank will use TransUnion credit reports, whereas TD Bank will use Equifax. Okay. So they're just different service providers for credit agencies. Your score is generally a score between 450 and 950. Obviously, the higher the score, the better. Okay, so if you have an average score, I guess would be around 680. So lenders are generally looking for a credit score of 680 plus. Okay. And we're talking major banks when I say lenders there. There are other lenders that will lend to clients with a lower credit score, but therefore they may charge higher interest rates or even fees, things like that.
I was wondering about that.
Yeah. So a higher credit score is important, but realistically, as long as you have at least the average credit score of 680, most lenders will lend to you. And then once you're qualified, you're qualified. Okay. So if you're dealing with a major bank such as TD Bank or Scotia Bank, it doesn't really matter if you have a score of 700 or 850. You're not getting a better interest rate from the bank because your score is that different. Once it's satisfactory, it is satisfactory. What's included in a credit report? Generally speaking, there's two sets of information. One is your personal information, obviously your name, address, birthday, things like that. And it also has a record of your employment. So your employers as well as your job titles during the last several years. So that personal information is all listed on the report. As well, again, your address also could have many addresses listed, depending on your previous address, depending if you've moved around quite a bit or not.
Good to know.
So that's your personal information. However, there is also financial information. That's obviously the nuts and bolts of the credit report itself. So when we're talking about financial information, we're talking about any what we call trade lines, and a trade line would be an account such as a credit card, a loan, a lease, maybe a cell phone, things of that nature. Mortgages have now started reporting to the credit reporting agencies as well. So not all mortgages report to your credit reporting agencies, but most of them do now. Okay, and that's the same as cell phones as well. Cell phones weren't generally on credit reports in the past, but now your cell phone account is also listed on their credit report. Right? Yeah. It's a bill. It's a bill. So what's happening is every month, maybe it's not always every month, but generally it's once a month or every other month, the financial institutions or service providers like Rogers cell phone bills or something will report to the credit agencies on the status of your account. And they will let the credit report agency know if you're up to date, what the balances is on the account. So we know the credit limit, we know the balances, we know the minimum payments. Okay. There's also going to be a track record of your payments. So we'll talk about this a little bit later, but it's very important to make your payments on time. And if you're ever more than 30 or 60 or 90 days past the due date of your payment and it hasn't been made, that's going to be recorded on your credit report and it's going to stay on there ongoing.
So what happens if you're just a couple of days late?
So generally, let's say my bill is due on March the 1st, or let's call it March the 10th for this example. And March the 10th rolls around and I haven't made the payment until March the 12th. Well, generally that's too close to missing the payment where it hasn't been reported yet. If you're generally more than 30 days past the due date, that's when it's going to get reported. Okay, so there is a little bit of a saving grace, but really the idea should be you make the payment before or on the payment due date, not after that. Okay. Anytime you miss it after that, you are running the risk, but generally speaking, the banks won't have a negative connotation on the report until you're past the 30-day mark. What else can show up on your credit reports? You may have things like if you've declared bankruptcy, or if there's a collection item that's been registered against your name. And bankruptcies aren't as common, but they do happen, as well as consumer proposals. But I do see quite a bit of collection items registered against people when I'm doing applications for financing. And the collection can be something very small too. Like, let's say, for example, you have a cell phone bill and you have your last bill, so you've made the payment, and the payment maybe was $100. But during the course of the time where you got the bill, until the time you made the payment, there was an extra service charge added on, or maybe in a different example for a credit card, there could be some accrued interest from the time the last bill was issued until the day you make the payment. And then you could have a small remaining lingering bill of say $10, $20, which you weren't even aware because you thought you had paid it. Sometimes these accounts then go to collections and it's reported to your bureau, and that's a really negative connotation to have, comments to have on your credit report. So you want to make sure that when you are closing any bills, or you're done with any service provider, that you're making sure that the bill has been paid, and you're following up after to make sure there was no outstanding service charges or accrued interest in those accounts as well. So let's talk about what are the drivers for the credit score, because obviously credit score is important in order for you to get approved for the mortgage. But let's talk about what the drivers are. So the most important, and again, the credit agencies don't actually report to us what the actual drivers are, probably for fear for manipulation exactly of it. However, we do see trends of what generally will go towards driving your score up and bringing your score down.
So what do you mean by drivers?
So what are the main factors, the reasons why your score may increase or decrease? Okay. So that's what we call the driver. So for example, what we just referred to about making your payments on time, that's the number one reason for your score going up or down. Okay. So keep in mind that your score is always going up or down every month. Okay. The score goes up, the score comes down. It's a revolving score based on how you're operating your accounts. Once you've missed a payment and you've missed that due date, the credit score will reduce. And that black mark, if you will, call it that, will stay on your report. Okay. So let's say I have a TD visa and I missed the payment and I missed it by 2 months. And the TD reported to the credit agency that I missed that payment for 2 months, the minimum payment. So I went on vacation and I forgot to make the payments when I was away for whatever reason. That mark that you've missed it you missed it for 2 months will stay on your report forever, as long as you have that credit card. Another reason that the drivers for your credit score be something we call credit utilization. So credit utilization is how much of the credit you're using towards the credit limit. So let's say, for example, I have a $10,000 line of credit at Scotiabank. Well, in that case, if you use over 75% of that credit line of credit, that's the utilization of the credit. And we believe that over 75% of credit utilization will also drive your score down. So you should always try to have a balance that's below 75% of the credit limit. Maybe for your own safety reasons, do it for 50% of the credit limit. And then if you need to carry credit for whatever reason, make sure you're raising your limit so that your actual balance is no higher than 75%. That's also another driver for your credit score. A third thing that comes to mind would be any negative connotations such as bankruptcy, consumer proposal, or like we mentioned earlier, a collection item. Those things will go. So those things are the main drivers, I feel. And then you have some smaller things like the amount of credit you have outstanding. Obviously, if you have 15 different credit cards, that's going to be a higher credit risk than someone that has maybe 3 credit cards. Okay, so the number of accounts you have and the amount of debt you have outstanding also goes into factoring the score that you have. Heather, how does somebody get credit if they don't have any credit cards?
Yeah.
Well, generally this is a problem that everyone will go through. There are companies out there where you can apply for a credit card, and some companies will just grant you a small credit card with a small balance. So for example, if you walked into your local branch, especially if you have a relationship with that branch or that bank from working or just having a bank account there, the bank will give you a small credit card. Okay, and that will get you going. Or somebody could co-sign that credit card for you. Let's say if you have a parent or a close family member that can co-sign that credit card, that's another option. But let's say you don't have the option for a co-signer. One of the things that you could do is do something that they call a secure visa. So what you could do is take a $500 that you have in savings, for example, and the bank will secure that in an investment like a GIC, where you cannot cash that out. And then they'll give you a $500 credit card that matches that secured GIC. That way, if you're not handling the credit facility properly, they can always cash out their credit card, or the GIC, sorry, use that to pay off the credit card, and then they're not at a loss situation. So they're more willing to get you started in the credit reports without having any score to go on. Okay? Yep. So that's something that you can do to help get started. And why does it matter? I feel that it's important to have good credit for a couple different reasons. Number one is obviously if you need to have the minimum credit report in order for a bank to approve a file for you. So for example, let's say I have the average score is around 680. Well, if your score is say 550, most financial institutions, major financial institutions, will not lend to you. Okay, for mortgages. So you just won't get the approval in place if your score is too low.
Can they go somewhere else?
Yeah, you also do have options. See, what we call the major banks in Canada, they're like A lenders. They're our top of the line lenders. We also have a secondary set of lenders that we can access as mortgage brokers that we call B lenders. Now these B lenders will advance funds and approve mortgages for clients that may have poor credit, as well as other things like income confirmation issues or whatnot. So in this particular case, they will approve, but the rates will be higher. The interest cost will be higher. So having the good credit allows you to get approved at a major institution where the interest rates are less. Okay, so that does it does help you save money in the long run by just making
just make sure your bills paid on
yes.
time, bottomly, right?
having good habits,
yeah.
Not maximizing your credit. Those are the main drivers, and those are the main things that you can do in order to make sure that you have a good credit score.
That's wonderful. Thank you so much, John. Anything else you'd like to cover before we head off?
I think that's all we can talk about for credit reports right now, but I'm happy to come back another time if you have any other questions regarding anything else.
Wonderful. Thank you so much. So the bottom line, people, pay your bills on time, use that extra money to take a wonderful vacation. And thanks again, John, and hope to see you again soon. Thanks for watching.
Okay.